Good morning. I'm Peter Stanton, publisher and CEO of the Worcester Business Journal, and it's my pleasure to welcome you to our annual economic forecast event, an event we've co-produced with our partners, the Worcester Regional Chamber of Commerce, for many years. Last year, we held this event on February 12th, where our panel predicted another ho-hum year of incremental growth. And how did that work out? Who knew that the black swan would fly into the picture frame and turn our lives and our economy upside down? Well, we all know sometimes things are really hard to predict. And what you predict in February is not always how it turns out in December. That was further reinforced last year when we asked a question to our attendees, who's going to be on the Democratic presidential ticket in the fall? And I have a slide that shows you what 35 of those 200 attendees, where their votes landed as to the Democratic ticket. So here were all the people who attendees at last year's economic forecast thought would be on the ticket. And you can see lots of familiar faces. That's Governor Gretchen Whitmer down in the lower right, Julian Castro. Lots of familiar faces, 13 total people on that list. And here's how people voted in terms of whether they'd be the presidential nominee or the vice presidential nominee. You can see in red, you've got Biden with three people thought he would be the presidential nominee and one Kamala Harris vote. So, and for the winner, by the way, 80% of entries were picked Trump, 3 Klobuchar, I think, and none picked Biden to win. So that was last year. And this year, we are so confident in our brilliant economists and panel of industry experts that if they don't nail it in forecasting how 2021 will go, I will personally be sure that each and every one of you gets a full refund on the cost of attending this event. Okay, on a more serious note, we're thrilled to have Michelle Meyer, head of the U.S. Economics for BofA Securities, as our keynote presenter, and a terrific group of panelist presenters to back her up, which includes John Regan, President and CEO of AIM, Bob Luz, the President of the Mass Restaurant Association, and Travis McCready, Executive Director and National Practice Leader for JLL Life Sciences. Making this annual forum happen takes a lot of planning, and we appreciate the support we have had for many years from our event partners and our sponsors. So I'd like to thank our longtime partner, the Worcester Regional Chamber of Commerce, our presenting sponsor, Bank of America, our corporate sponsor, Bolus Lynch, and supporting sponsor, National Grid. Please let them know that you appreciate their engagement in this popular annual event, which allows us to bring you top-notch programs at no charge. So much for my refund promise, huh? Anyways, before asking our event partners and our presenting sponsors to share some opening remarks, I have a few quick notes. One, this event is being recorded and every registered attendee will get a copy of a link to that recording post-event. Two, to ask questions of our panelists or keynote speaker, please type it in the Q&A box located on your screen, and our moderator will try to get to as many of those questions as possible during the discussion period. And at the end of the program, we're going to be reviewing the winners of last year's 2020 Economic Forecast Contest. So that'll be something to look forward to at the very end. And now I'd like to introduce our longtime partner for this event, Tim Murray. Tim is the president of the Worcester Regional Chamber of Commerce. Tim.
Thank you, Peter. And we really appreciate the opportunity to work with you and your team, Brad Kane and Chris Prosser, to help bring this event to fruition. Clearly, as you articulated, things have dramatically changed, for all of us on this call over the course of the past year. But nonetheless, we remain bullish and optimistic about the future of Central Massachusetts and where we can go as we come out of this COVID-19 health and economic crisis. And like you, Peter, I want to thank the sponsors who are going to make this conversation happen today. Ed Shea and the team at Bank of America, former chamber board member. Ed, thank you. The corporate sponsor, Bolus Lynch, and the supporting sponsor, National Grid. We use 3 words to frame our work here at the chamber: recruit, retain, and incubate. And each one of the keynote speaker and the panelists I think, bring an experience and an understanding of our Central Mass economy and how in many ways it's a microcosm of what has driven the growth in the greater Boston area, and part of our ability to compete across the country and in many cases and in many sectors across the globe. So we want to thank them for being with us, and as always, look forward to this fun and engaging format, which challenges people to make their best predictions about what's to come. But here at the Chamber, we're very optimistic about the year ahead and regaining that momentum, which was clearly present before last March.
Peter, you're on mute.
Peter, yeah, you're on mute.
All right, I'll start that over. So there's Ed Shea, and it's my pleasure to introduce him. He's the Central Mass Market President for Bank of America. We'd like to ask Ed to say a few words of welcome and to introduce his colleague and our keynote speaker. Ed.
Thank you, Peter. Good morning, everybody. On behalf of Bank of America and our Worcester-based teammates, we are proud to again sponsor the economic forecast in partnership with the Worcester Business Journal and the Greater Worcester Regional Chamber of Commerce. Each year, this event brings together local business leaders, thought leaders, individuals, institutions, and others who care about our economy both locally and nationally. At Bank of America, our purpose is to make financial lives better, and we do that by supporting our clients and communities, whether we are addressing critical needs like homelessness, jobs, economic opportunity, social justice issues, or helping the community get through the pandemic. Our CEO charges us with delivering world-class capabilities locally. And today I'm very proud to introduce our esteemed colleague and keynote speaker, Michelle Myers. Michelle is Managing Director and Head of U.S. Economics at Bank of America. Based in New York, she provides timely analysis of economic data and Federal Reserve policy to senior management, our sales force, and traders. Michelle is responsible for our firm's economic forecasts, including the outlook for GDP, inflation, Federal Reserve policy, etc. Michelle earned her bachelor's and master's degree down the road at Boston University. Michelle's research is often cited in the financial press, and many of you have seen her on one of her many appearances, either on CNBC, Bloomberg, or many other media outlets. Michelle, thank you for joining us today, and I'll turn it over to you.
Wonderful. Thank you, Ed. It's really a pleasure to be here and to be able to spend some time talking to you all about the state of the economy. So I do have a few slides here that I'll go through. But before I get started, I think it's helpful to first have an appreciation of what we learned from 2020. The economy was hit by an unprecedented shock, the pandemic. And on the back of that, the economy was put into effectively hibernation for a matter of time. And we are still working on, getting ourselves out of that deep hole. But the good news, the very good news, is that we've been able to get out of that hole faster than many, many had thought. The unemployment rate right now stands at 6.3%, an impressive recovery from over 20% at the worst of the crisis. The GDP is back about 3/4 of the way to pre-COVID levels. And we think 2021, as I'll talk about momentarily, will really help to define a very strong recovery and solidify that recovery. And I think a large part of the reason that we were able to see the economy bounce back from this was due to the extraordinary amount of both fiscal and monetary stimulus, but also speaks to the resiliency of the economy and the fact that all else equal, the economy wouldn't have been slipping into recession, that it wasn't vulnerable for a recession in 2019 when before the pandemic hit. And in fact, household balance sheets were actually very healthy and were able to withstand what ended up being a very large shock. So let's turn to the next slide. And let's talk about some of these hard numbers. So you can see from the top right chart, GDP growth in 2020 fell by 3.5%. So you can see that blue line. You can see that on an annual basis, it was well in excess of the great financial crisis. So this has been the deepest recession in post-war history. But what's very different from the great financial crisis is look at the yellow bar. That's our forecast for this year, which we think will be 6% GDP growth. So a really pretty robust recovery, again, very different than the recovery coming out of the financial crisis, which was slow, it was bumpy. It felt like there were a few mini cycles within that recovery where the economy kind of reached stall speed. Not the case this time around. And you can see on the bottom right chart, if you look at real GDP, the solid blue line, and then the dashed line for the forecast, we returned to the pre-COVID level of GDP, which was the orange line, by the second quarter of this year. And by right around the turn of the year, we will have closed what's called the output gap for economics, which means that we will have made up for the lost output, all else equal. Why the strength? So as I noted, stimulus is a big part of that, and I'll talk to the numbers momentarily. We also have a lot of pent-up demand for consumer spending, with a good amount of excess money out there ready and certainly can be used once, very importantly, the virus numbers are low enough. So at the end of the day, the path forward for the economy is still very much a function of the path of the virus and as a result of the success of the vaccine. So on the downside, we do have to worry about a mutation of the virus. We do have to worry about potential gridlock in DC, although the latter doesn't seem to be a big challenge right now, given the progress towards stimulus. Let's look at the next slide. And let's zoom in here on consumer spending. So you can see on the left-hand chart, this is a long history of consumer spending in inflation-adjusted terms. It's the year-over-year growth rate. The shaded areas are recessions. So again, going back to 1960, this was off the charts in terms of how the consumer pulled back, but it was a forced reduction. People couldn't spend on certain activities as a result of lockdowns. There's still a lot of room to go in terms of seeing that full recovery for the consumer, hence the idea of pent-up demand. And when you look at the right-hand chart, there was a big rotation in how consumers spent throughout 2020. Goods spending did very, very well, recovered not only the loss from the initial pandemic hit, but above and beyond. People bought homes, the housing market is booming. We have double-digit home price appreciation today, which is absolutely remarkable. We have building permits running at 1.7 million nationally, mortgage purchase applications well in advance, well ahead of where it was prior to COVID, suggesting that demand is going to continue. So people bought homes, they're buying appliances, things, furniture, etc., housing-related spending. That's all good spending. But also electronics did really well as people tried to shift to working and living at home and buying what was necessary to do that. And at the other end, they didn't take trips. They didn't go to as many restaurants. They didn't go to the theater. You didn't go to your gym. You didn't go to your club. And services spending certainly was a lot weaker. So the pandemic led to this massive rotation towards good spending and away from services spending. And if you look at the next slide, and the main reason, again, for this was the fact that the viruses were high, right? We had a high level of cases back in the spring. You can see in the top chart here in terms of the positive test ratio. On the back of that, the economy effectively, again, closed down and made it hard for people to engage in services. Now, as we look ahead, the virus numbers are improving, and they're improving. You can see in the middle chart there, sorry for all these kind of little lines, but you can see, it's a little hard, but you can see that the drop in virus cases is across the board. The Midwest led this most recent surge in cases. And it has been coming down, but again, South, the Northeast, the West, all moving in that same direction as vaccination rates do pick up, which you can see in the chart here in terms of the share of the population across the world that have vaccines. The US is actually doing pretty well, not quite as fast as the UK or Israel, but making progress at a pretty fast pace, actually exceeding some expectations. So if the virus is indeed brought under control, if we avoid the mutation becoming a real dominant strain and creating major contagion, we believe that consumer spending on services will pick up. And we believe that there's plenty of cash out there to facilitate this return of consumer spending. By our calculations, there's 1.6 trillion of excess savings currently out there in the economy. It's remarkable the amount of cash that's out there, and more is to come, which I'll speak to momentarily. So the extent to which the virus numbers are lower, the extent to which they are persistently lower, economies can reopen, people feel comfortable re-engaging. There's a lot of purchasing power out there and a lot of pent-up demand for certain types of services, which should come back. And that to us is a critical factor for driving strong economic growth this year. If you turn to the next slide, the other clearly critical factor, again, for driving growth is stimulus, as I talked to. And I apologize, I realize these numbers are probably very small in the table. But essentially what we do is look at the stimulus bills and measures that have already been passed, which total $3.7 trillion, 17% of US GDP. Biden's stimulus plan of 1.9 trillion would be another 8% of GDP. That would bring the total to 5.6% or 26% of GDP. Unbelievable in terms of stimulus. And that has created an environment where disposable income has been very well supported. And it's an amazing fact about this cycle is that disposable income never declined. We have been above pre-COVID levels for income this whole time, even in the heart of the recession, because of the transfer payments from stimulus, and that is continuing. The other factor, of course, is the Federal Reserve's policy. You can see on the right-hand chart, the Federal Reserve's balance sheet as a percent of GDP is high, and it has been a bit of a hockey stick move up. So, and we think it will continue. So by our calculations, by the end of the year, we'll be at about 40% of GDP in terms of the Fed's assets. And just to refresh everybody's memories here, the Fed is buying treasuries, they're buying MBS, and they launched this new round of asset purchases, or QE, right when the crisis hit, as a way of putting in place greater liquidity in the system. So they really had to pump a lot of money in very, very quickly in a shrinking economy in order to make sure that liquidity was flowing and capital was available. The Fed also expanded their balance sheet very slightly, but did expand from their 13 different credit facilities they put in place when the crisis was hitting as well, right? Backstopping credit markets, backstopping muni markets, and again, making sure that they were truly the lender and the buyer of last resort for a market that had at times been failing to operate properly. So the Fed's balance sheet is very large. You're getting a good amount of monetary stimulus that is working hand in hand with fiscal stimulus. And we don't think it's over. As I noted, in the spring, we will see another round of stimulus, whether it's 1.9 trillion or something less. We'll learn in the next few weeks. It depends on the process that they use to get stimulus passed in Washington, whether it goes through a reconciliation process or if they attempt a bipartisan deal. It seems like the former is likely the most likely path. And then the Fed is, giving no indication that they are planning to let up on asset purchases yet. But we do think by the end of the year, we will be, the stage will be set for a tapering of asset purchases, which means they just buy at a slower rate. And that will go on for about 6 months. So maybe by the middle of next year, the balance sheet will be able to be kind of constant, but at very, very high levels. And importantly, it's not just the balance sheet that matters for monetary policy, it's also the level of interest rates. And the Fed is at the zero lower bound and has embraced a policy where they're looking to actually overheat the economy effectively, right? Targeting an average of 2% inflation, which means after undershooting on the inflation target, they'll need to overshoot on the inflation target for some time. So that's a very stimulative monetary policy above and beyond what was done after the great financial crisis. So fiscal policy, much, much larger than after the financial crisis, and monetary policy, much more aggressive as well. So if we turn to the next slide, I want to spend some time on this slide. It's actually extremely important when we think about the recovery. What I just talked about and spent the last 15 minutes talking about was about the aggregate numbers, the macro, the large macro picture. But what's happening on aggregate really does mask a lot of what's happening under the radar. And I think in this cycle, maybe more so than in others, the inequalities of the recovery have been really stark. And that's because of the nature of this shock. So a way to characterize this has been the K-shaped recovery. And there's some numbers on this page that help to give a sense of the magnitude here. This is a summary of the labor market. And you can see the data as of the December jobs report, so the full year of last year. You can see that it's ranked by the healthiest of the weakest part of the economy, where there's been, the level of jobs relative to the pre-COVID level. So you can see financial activities, utilities, manufacturing, construction, even retail trade, because of the increase in goods demand, they're all almost, if not at pre-COVID levels. But look at the bottom of the list, leisure and hospitality. Still a lot of work to be done in terms of healing that part of the economy. So if you think about the total amount of jobs, just focusing here on the private sector, we lost about 12.6 million jobs. I'm sorry, we lost, I apologize. We had regained 12.6 million jobs, but there's still about 8.5 million jobs that are lost relative to pre-COVID levels, right? So that's a recovery rate of about 60%. And for leisure and hospitality, there's still 3.9 million jobs that are out. So about half of the total jobs that are still lost relative to pre-COVID levels, half of those are in leisure and hospitality. So it really speaks to the fact that folks that are exposed to that sector are certainly feeling a bigger economic drag than others that are in other industries where it's easier to have a virtual workforce, and maybe are actually reaping benefits of productivity gains and efficiency gains and lower costs on the back of the change in the workforce. Now, the other important factor here is that leisure and hospitality workers are, on balance, the lowest paid workers. So if you look at the labor market by income cohort, the top 50% of the income distribution, the aggregate jobs numbers are actually above the pre-COVID levels. They've earned back the jobs. But for the bottom half, jobs are still down about 15% or so from pre-COVID levels. Wide gap there. The other stark difference when you think about inequalities is from the gender level as well, right? Women have been hit a lot harder in this cycle than men, in part because of the composition of the industry. Leisure and hospitality workers also tend to have more women. Women have also had to drop out of the labor force because of childcare issues, with kids not going to school, with health concerns, caring for older relatives. So the labor force has dropped meaningfully for prime working age women. And the goal, of course, that the faster the recovery comes, the stronger the recovery is, the better we do on the health front, the easier it will be to get those folks back into the labor market, and shrink some of the divide that's been created. But this is at the forefront of policy right now. The economic team, the Biden administration is really focused on this, and the Federal Reserve, when thinking about monetary policy, is also keenly focused on these issues. And I think that that is important to keep in mind, because it's not just getting the overall unemployment rate down. Yes, that's good. Yes, it's encouraging. We're at 6.3% unemployment and heading down. But it matters, the composition matters. And to get a sustainable recovery, it needs to be a broad recovery. It needs to be one that can generate proper wage pressure across the board. And it could be one that ultimately, going back to the Fed's mandate of getting higher inflation, generates this push from wages into overall price pressure and inflationary pressure. So at some point in this cycle, if we're right, if we get 6% GDP growth this year, 4.5% GDP growth next year, the unemployment rate falls, inflation will come back. The Fed is committed to getting inflation back. And there's a lot of market participants that are actually starting to price in and become increasingly worried about a real upside surprise to inflation. We are not that concerned yet, but we do think that that's something to keep in mind, that unlike the last cycle, which was characterized by a low growth environment, this cycle is a high growth environment, which means that there's a better case to be made for inflation to actually move up. Not necessarily this year in a meaningful way or sustained way, but you could envision by the end of next year. And that's why we think that the Fed, by the end of 2023, will be able to start increasing interest rates. They will have met a lot of these metrics. They will have achieved this inflation overshoot. They will have achieved the proper broad-based labor market recovery, and they can begin to unwind slowly, but yes, bring interest rates higher. So why don't I stop there? And Peter, perhaps I'll turn back to you.
So Michelle, thank you very much. I'm actually jumping in now. Hi, everyone. I'm Brad Kane, editor of the Worcester Business Journal. So again, Michelle will be joining us on our panel shortly, but meeting now is to introduce our other three panelists again. Each will give about a 5-minute presentation on their area of expertise, and then we will jump right into the Q&A. And for those of you who have questions, certainly type them into that Q&A box, as Peter mentioned, and we will get to them over the course of the panel. But first, I'd like to introduce John Regan, who is President and CEO of the Associated Industries of Massachusetts.
Thanks, Brad. I guess I was a little confused. I thought you said it was a 5-hour presentation, so I'll try to trim it down accordingly. Obviously, that was
like 4.5 hours.
So I want to thank the Worcester Business Journal for inviting me and the Worcester Chamber for their great partnership for this event, as well as for their partnership with AIM over the years. I want to begin with some good news. The AIM Business Confidence Index, which we've been publishing monthly since 1990, came out on Tuesday in positive territory for the first time since COVID arrived back in February, March. 52.4 is the overall index score for January. 50 is a neutral reading, and anything above is positive. So obviously nicely in the positive territory. And the other sub-indices that make up the Business Confidence Index are also trending in a very positive direction. One of our economists who helped us review the data made a comment about the fact that the outlook for conditions 6 months from now is a full 8 points higher than the assessment of current conditions. And that sends a really strong signal about the potential for economic recovery. And this member of the Board of Economic Advisors said, and I quote, "The hope is that employer confidence in their own company prospects continues to strengthen and drives decisions to increase investment moving forward." So kind of tracking with what Michelle said, as things improve, the hope is that that pent up sort of opportunism or optimism, let me pick the right word there, begins to propel investment decisions. So that's the good news. Of more of a challenging picture now is what's happening in the jobs market. And again, that's what Michelle ended with, so I won't belabor the point, but the current unemployment rate in Massachusetts, 7.4%. It's certainly better than the 17 plus that we had back in March and April, but it's still really high. And of greater concern from my perspective is the labor force participation rate, which has dropped from 68% in October of 2019 to 64.5% in December. And just to explain what that means, this is the number of people who are eligible and otherwise would be able to work, which would be 100%, and 64% are currently in the labor market. The rest are sitting on the sidelines waiting for things to come back to normal. And since AIM has at least one of every type of company in our membership, our members have gone through a mix of experiences in the last 11 months. Many of my members were deemed essential, particularly in the manufacturing space, and they were open virtually from the beginning, including those in the grocery space, pharmacy, healthcare space, and as I mentioned, manufacturing companies that were deemed to be essential. And basically, the rest of my manufacturers were able to reopen in phase one. Many of my members are in the finance, insurance, real estate space, legal space. And for them, and sort of, again, affirming what Michelle said about the experience of people who were able to continue to work, the experience has been different, but from a financial perspective, not all that painful. However, On the backside of that coin, we all know that small businesses, so hospitality, entertainment, arts, sports, restaurants, were hit really hard. And I'll leave it to my friend Bob to outline the impacts on his members, which have been quite severe. I would also offer this observation, and sort of as we look into the future, what does recovery look like? The work from home experience appears to be a enduring aspect of how we come out of this. I think employers have figured out that being able to distribute their workforce outside of the normally densely populated urban areas is something that actually works. Employees seem to like it. Productivity has not been impacted. There are some for whom work from home is a challenge. I would mention in particular caregivers, and those caregivers could be parents with students, parents who are taking care of elderly parents or other sick people in the home. And so, that presents a little bit of a challenge in terms of the success of work from home. But for the most part, it's worked out pretty well. And what I worry about is the impact that has on those urban areas in Massachusetts, the densely populated ones, and how the lack of people back in the office is going to affect the economies of those areas. I get into One Beacon Street about once a month. I have to co-sign the big checks. But in any event, when I do go in, I'm at we're at One Beacon. The 16th floor has about 36,000 square feet. When I'm there for those rare occasions monthly that I have to go in, I'm the only person on the floor. And if you haven't been to Boston lately, it really is a ghost town in the downtown area. There's no pedestrian traffic. There's very little vehicular traffic. There's certainly no tourists roaming the streets. And so all those businesses that depend on that traffic are dead in the water. And it's really quite a challenge. A couple of last quick things I want to mention. The types and kinds of jobs that have been lost in this pandemic have only sought to highlight the wide disparity in terms of the gaps between the haves and the have-nots. And it's something that I think as a business community, we need to be worried about, not just from an economic standpoint, but from a societal standpoint. I've given a couple of speeches in the last couple of years where I mentioned the fact that we call ourselves a commonwealth, and that term we have chosen deliberately as a society. That's how we want to be known as a commonwealth. And what that means is we need to be worried about the economic well-being of our fellow citizens. And I think at the moment, some folks doing really, really well, others doing really, really poorly. And I think the success of how we come out of this will be measured by how well everyone does when all is said and done. I'm obviously going to be part of the panel going forward and hopefully be in a position to answer questions. But at the moment, I think I'll leave it there. Thank you.
All right, well, thank you, John. And then we'll have you join our panel in just a few minutes. Next up, we have Bob Luz, President and CEO of the Massachusetts Restaurant Association. Bob?
Thank you very much, Brad. Thank you for inviting me here, and I appreciate WBJ and the Worcester Commerce, Chamber of Commerce for the invitation. So I do represent the restaurant industry. And, as we begin to talk about what the future looks like, I'm going to try to quickly frame this and talk about where we were before this, during this, and as we exit it. So if we can go to the first slide, no question about it. When COVID hit in March of 2020, it really was the best of times for the restaurant industry. I mean, we were rocking and rolling coming through 2019 into 2020 for 4 years running in Massachusetts as well as nationally. 52 cents of every food dollar was spent away from home. So that meant it was spent in some form or another into the restaurant industry. When you look at our state, we had just over 16,000 restaurants from Boston to Pittsfield, Newburyport to Provincetown, and everywhere in between. We were known as a national and international culinary destination. We have James Beard Award winners strongly in the greater Boston area, but also in Worcester and out in Western Massachusetts as well. The industry employed over 301,000 people within the four walls, just within the four walls of our industry, largely driven by a part-time workforce, second jobs for a lot of folks. And that number does not include all of the people that service us and sell us goods and services. When you bring the business partner community into this equation, it really is breathtaking how big it becomes. What the restaurant industry has always been known for, why I've been in it for, 38 years now. We are the industry of choice and really the land of hope and opportunity, I think, for a lot of folks in this country. And we are the path to, really middle income and beyond for minorities, new immigrants, women. And in fact, we have the highest percentage of entrepreneurship for those demographics across the country. I can tell you, I've seen it firsthand. People actually do go from the dish room to the boardroom in this industry. It's what I love about it. It's why I've stayed in it. Reason being is you don't have to be Harvard educated. You have to know how to treat people with dignity and respect. Total sales in the state were 19.1 billion. And the biggest challenges we had was we didn't have enough employees, and really we were over penetrated in a lot of markets. And I was really getting nervous because developers were finding great chefs, putting them into new locations. And even a lot of those chefs made beautiful food, but really I questioned whether all of them knew how to really run a full business. And that was really a big challenge for us. So as the COVID hit, and as we really got into it, I came across a stat that blew me away, having been in this industry the whole life. I knew we were a really large industry, but I really didn't realize how big it was. And if you can go to the next slide, this really does frame it. This came out of a white paper that I saw out in New York, and it talks about the scope of the industry and the challenge involved in reopening a closed industry. So $864 billion nationally. That means it was 35% more than the combined revenues of all of those industries right there that are listed. And that just blew me away. I had to do the research to make sure it was right, and it was spot on. And it really talks about how small business, when you take that collective group of restaurants, how truly large it is. And it really blows you away. And it frames why the government has continually looked at it as really a big challenge as we go forward. So let's talk about what happened, if we could, once COVID came. No question about it. If we can go to the next slide, that'd be great. March 15th, Lieutenant Governor Polito called me and said, how quickly can we shut down the industry? And the day had come, and we were the first industry shuttered down. She gave us 2 days. Largely people were closed by March 15th, but March 17th was the official day. From that point forward, we furloughed for all a part of this time over 255,000 people. That's the point Michelle was talking about. We have still yet to recall almost 100,000 of those folks, 38%. We reopened for outdoors on June 8th. We reopened for indoors on June 28th, which presented a lot of challenges, the biggest of which is when we found out we were opening outdoors only the day before, 81% of the restaurants in Massachusetts were not permitted to have outdoor seating. We worked with the governor to get an executive order signed, and he flattened out a 10 to 12 week permitting process and really gave it to individual cities and towns who embraced it and moved quickly, including the greater Worcester area and many municipalities around there. To date, 3,400 restaurants across the state never reopened from the shutdown. Doesn't mean they're closed. We don't know that for sure, but obviously every day that goes forward, less and less of a likelihood. In August, we started saying, holy mackerel, winter is coming. People wouldn't think of that in August. We were. And that presented a whole bunch of challenges, if you would. As we went in, all of a sudden it started to get a little bit colder. We had the seasonal change. We started to lose outdoor dining. And then the second sort of surge hit. and the governor rolled back. We went to a curfew, 10 to 5. That really changed it. We lost the whole second seating across the state. And then when we went to 25% occupancy, which we had been at 6-foot social distancing the whole time, that really put the nail in the coffin, if you would, and caused a lot of restaurants to hibernate, meaning these were restaurants that had been open for the summer and fall, but decided they needed to close as a way to make it through to the other side. All of this has been done while absolutely we have proven that we are safe, we're operating safely. There's been over 20,000 inspections by the Alcoholic Beverage Control Commission of restaurants since the end of August. 98% of those have been in full compliance with COVID protocols. Less than 0.4% of instances of sickness traces back to restaurants. In fact, in the area, on the time frame that we saw the largest spike, sort of 12/20 to 1/16, 42 cases traced back to restaurants. 57,513 were from households. And reality is because when I go out to eat, I go with my bubble. I go with my family, or I go with trusted friends, people I know where they've been. When we're in households and there's unsupervised, unregulated gatherings, we're there with friends of friends, and we don't know where they've been. And that's really what I think the governor's been so concerned about. And that's really what we believe drove this. Restaurants are safe. So let's fast forward now and talk about, well, once we get to the other side, what does it look like? Well, the reality is restaurants are ranked #1 on a very bad list. We have been the most decimated industry of all. Everybody's been touched. Nobody's been left alone, but restaurants sit alone at the top. The good news is we've had recently some strong movement in both the state and federal assistance coming. Massachusetts, you know, when the governor realized he had to roll back to 25%, we really had been pushing for a long time state grants. We said, you got to do it now. He came out and put out $682 million additional dollars in state grants, the largest state grants available in the country, with restaurants at the forefront of those. And then the second round of PPP coming out of DC, that's really where we need the help. That's really where we're going to get the most help. The business model for restaurants is forever changed. And this is really important. Prior to COVID, in a full service restaurant, forget restaurants that are built for takeout and delivery, but for a full service restaurant, 92% of the sales were within the 4 walls of the restaurant. Last summer, probably about 25, and now we're probably closer to 35% of sales were to go, whether that was delivery or just picked up. 40% was outdoors and about 30% was indoors. That business model is going to change, is changed forever, and it's going to stay there. And that means really different things for a restaurant. It is much more expensive to operate outside. It's far more expensive to put to-go packaging together. We have a really philanthropic group, a very resilient group. They do bend and stretch. But, you know, here's the good news. We now see the other side for the first time. The other side is April 1st. And that's because outdoor dining will start to come back. The silver lining for this whole thing was outdoor. We were very parochial about our approach to allowing adult beverages outside the 4 walls. No question, every community across Massachusetts embraced it and rolled out with it. There's clearly, as Michelle pointed out, a pent-up desire to go out and start to live our lives again, and we believe that's really going to help. Look, let's face it, there's less inventory of restaurants, so those that are there are going to be, we believe, are going to be very busy. And as we get to June and get, you know, the vaccinations into all the arms, confidence is going to be high. People are going to want to come back. Our workers are going to come back to the cities. Tourism is going to be, we think, coming back pretty well in June through the summer. Sports, we expect to kind of see people in stadiums again. And then we're fully expecting that everybody's going to be back in school by September. And I think we're going to really be strong. And restaurants led the rebound out of 2009. We're going to be a little bit behind the curve here, but I think we're going to really come on strong in the back end of this year. So with that, I'm going to stop because I went a little bit over and I apologize.
No worries, Bob. I think we have a little buffer built into the system anyway. So next and last but not least, the man with the most impressive title, of everyone. I'd like to welcome Travis McCready, who is Executive Director and National Practice Leader for JLL Life Sciences. Travis, take it away.
Awesome. Thank you, Brad. Titles mean nothing unless you're getting paid by the word, right? Or paid by the letter. Hi, everyone. It's great to be with you. I want to first thank the Worcester Business Journal and the Greater Worcester Chamber of Commerce for sponsoring this event. I wish we were doing this in person. I miss you all, my friends and colleagues in Worcester, and I can't wait to be with you all in person again sometime in the near future. So I wanted to spend a little bit of time talking about the life sciences, not just in the greater Boston context, but in the national context, and specifically towards the end, talk about Worcester and central Massachusetts. It's a really exciting time for the life sciences, and I hope that you all, by the end of the presentation, will feel some of the exuberance that I'm experiencing on a daily basis in this industry. So next slide. Awesome. So let's step back for a second, and apologies to those of you for whom this is remedial, but let's set the stage about what it takes to have a successful life sciences cluster pretty much anywhere in the world. There are some very key ingredients that an ecosystem needs to have, starting on the bottom southwestern corner there with research institutions. And that could be research institutions, or I could just simply call that education, because I do want to be inclusive of K-12 education. Every life sciences infrastructure and ecosystem starts with talented individuals and intellectual property. And that's research, basic research coming out of institutions of higher education. It also comes out of nonprofit institutions like the Broad Institute and the like. That basic research ultimately gets what's called translated into an early stage startup company. Those companies tend to leave the research institutions and head to incubators like Lab Central or MBI. And those early stage companies are oftentimes funded by the NIH through SBIR or STTR grants. And it's at that stage that these companies are testing out their approach, testing out their technologies, and maturing to the point where hopefully, if their targets are correct, they will be recipients of venture capital funding. This VC funding is critical for companies in the life sciences to take risk, to continue to develop their products and enter into clinical trials. Alongside that moment, you need very experienced lab developers and service providers, because once you receive that venture capital funding, you're too big to stay in incubators, and you have to go out into the wild. These companies will gravitate towards the best infrastructure that's out there. And there are companies like Alexandria that have essentially built their entire business model around creating great lab space across the world. As you're continuing to grow the scale, these companies are starting to attract more mature types of capital and entering into conversations and alignment with large pharma, large med tech. And you want to be proximate to a large pharma and large med tech to have these types of funding opportunities and industry relations that ultimately lead you into clinical trials and having a patient experience to test your technologies at research and teaching hospitals. It is at that point where regulators and the regulatory scheme becomes critical in order to get a technology to commercialization and into the hands of patients. And it's not just the regulators themselves, the FDA, but it's also the service providers, the lawyers, for example, who could shepherd technologies through the FDA process, being proximate again to those lawyers, those skilled lawyers, and that is not an oxymoron. Those skilled lawyers who can help you through the regulatory process is critical. All of that is some of the necessary core ingredients of a successful life sciences cluster, whether you're talking about the East Coast, the West Coast, Canada, Europe, or Asia. These are core componentry for a successful cluster. Next slide. So where do we sit? And it's not surprised that there's a bit of a hegemony given those core ingredients. There's a bit of a hegemony in the United States, where Greater Boston, we sit and have comfortably sat in the #1 position for years, followed closely by San Francisco and San Diego. And then there are just a list of cities and regions that are rising stars in the life sciences ecosystem. But look at that number of total lab inventory. And these numbers are old, based on about 9 to 10 months old. 45 million square feet in Greater Boston of total lab inventory. And that's part of the reason why we're so strong. These young companies that are graduating out of higher education, they have a place to go. There is lab inventory, but even with that total amount of lab inventory, our occupancy sits below 3%. So there's incredible demand and not enough supply for lab space here in the Greater Boston area. Next slide. So why are we all these communities jostling over the life sciences sector? It's not just about curing people's lives. Yes, that is absolutely top line, #1, and part of it. But it's also the economic development aspect of this industry. We've seen here in the Greater Boston area a 54% growth in employees from 2015 to 2020. But in addition to that, we've also understood that for every new biotech job that gets created, 4.2 jobs are supported downstream. Now, granted, yes, there's a little bit of hocus pocus in multiplier, the multiplier effect, and Michelle is probably scoffing at the multiplier effect offline. Economists hate this concept, but just think of it in more generally, that these biotech jobs, it's not just about the PhD scientist herself. The industry supports construction, supply chain, manufacturing, education. Pretty much every of the major professional areas are supported by a healthy biotech industry. So it's no wonder that cities and towns and regions across the United States are trying to figure out how to not only just grow their life sciences ecosystem, but how to eat Greater Boston's lunch. Next slide. So this is this is a good news and bad news story for us in Greater Boston. The good news is, look at that number, $92 a foot on average for lab rents in the Greater Boston area, significantly higher than the national average of about $84 a foot. That's the good news. The bad news is everyone knows in the life sciences industry that it is expensive to be here. So every day, every week, every month, we in this community, we have to redouble our efforts to make sure that companies and investors see the value proposition of being here. And we could talk for hours about what that value proposition actually is, but generally just think of it in terms of speed to market. This is the most important concept for life sciences companies, is the ability to get your discovery, from research and basic research into the hands of patients as quickly, efficiently, and frankly, as cheaply as possible. And part of the reason why our ecosystem here in Greater Boston is so dominant is that we continue to focus on this concept with how we architect and structure our ecosystem. Next slide, please. So let's go back. These are the core concepts. Where does Worcester and Central Massachusetts fit in the picture? And I ask myself, and we ask ourselves, the leaders in the Worcester ecosystem, ask themselves this question on a regular basis. And it puts Worcester in a really interesting position to be both part of Greater Boston, but also importantly, Worcester has the opportunity to think of itself as a self-sustaining life sciences ecosystem on its own. We have great research institutions like WPI, and WPI's reputation just continues to crescendo within the scientific community. We have extraordinary incubators like MBI. MBI continues to produce great product for early stage companies and continues to be ahead of the curve in providing them with formats that they need. We're a little soft in the Greater Boston and Worcester area on venture capital, and here's where we definitely draft off of the VC experience that's in the eastern part of the state, in Greater Boston. But we're close enough and more proximate enough to be able to comfortably draft in these areas. Our developers are gaining strength. They're gaining strength and expertise, and we continue to attract national players. Just as a sidebar, not a day goes by where one of the 20 largest of the national developers is not reaching out to me to ask about Worcester and what's going on in Worcester. Where are the opportunities in Worcester? So you're on the radar screen. In terms of mature capital and industry relationships, again, this is where we're maturing a little bit. Yes, we have AbbVie. We have Cytiva in Shrewsbury next door. But as each year goes by, more and more of the large global players are finding a home in the central Massachusetts area. And that just bodes well for these deep industry relationships that will help technologies and companies mature. And who can forget, of course, the elephant in the room in terms of research and teaching hospitals, UMass Medical. It is a verted, productive institution, not only just in terms of the Massachusetts ecosystem, but in terms of the U.S. Ecosystem. The UMass system comfortably sits on the top 50 list globally of patent recipients of higher education. UMass and UMass Medical is a formidable player within the life sciences. So Worcester, you can think of yourselves, and we can think of ourselves, not only just as being part of the Greater Boston ecosystem, but we have leadership opportunities in our own right here in the Greater Worcester area. Next slide and final slide. So just to give you a sense of where things sit from a real estate perspective only. And we could talk for hours about the great labor and education things that are happening in Greater Worcester, but let's just talk about real estate and who's here. This gives you a little bit of a map from a real estate perspective. 12 life sciences buildings, over 1 million square feet in lab supply. If you were to go back to a previous slide, you would see that 1.2 million square feet of life science supply actually alone exceeds one of the top 15 markets in the United States. I believe it's Minneapolis, St. Paul. But our availability is, while it might be high, the vacancy rate is incredibly low. So there's this tension that we must wrestle with about how much lab space can we and should we build. I've been working on through the great leadership of Tim Murray at the Chamber and Ed Augustus in the city manager's office. We've been working deeply on a manufacturing strategy here in Worcester that has led to Wuxi Biologics locating here. But there are incredible opportunities going forward for Worcester to continue to ascend in the life sciences ecosystem. So as Bob noted, yeah, I kind of went over too, but I love thinking about the prospects of this city, this region in the United States life sciences context. And I hope we can get into some of those questions about this during Q&A. So I'll pause here.
Thank you, Travis. And at this point, let's start our panel with everyone. So Bob, I see you, John, as well. And Michelle, if you're still there, if you could join us as well. And I'm actually gonna, we'll start with the first presenter. So Michelle, I want to talk about the stock market just briefly, maybe as an economic indicator or not as an economic indicator. So the stock market's obviously close to record highs right now. How much of that reflects the reality of the economy now, or not so much? And will that sort of continue to be the case for the foreseeable future, or we sort of see a reckoning at some point?
Sure. So, I mean, clearly the stock market has ran well ahead of the recovery and has for some time. Throughout 2020, it was the same situation. You kept seeing the stock market exceed expectations with the economy kind of chugging along. So there's a few factors in play. I mean, the first is clearly the stock market is supposed to be forward looking, and the economy has since rebounded, and we are expecting very strong growth in 2021. So presumably, pricing that in. But the other two other factors there. I mean, and I think another one, if you think about the where the weakness in the economy has persisted, it's been disproportionately smaller businesses that tend to be private. The large public global companies have fared better, and that's what's being captured in the S&P 500. And then finally, I would say it's monetary and fiscal stimulus, right? There's a lot of cash that's sloshing around there as a result of fiscal stimulus, and some of that is, of course, going into investing. And then on the monetary side, the Fed is keeping the cost of capital very low, keeping interest rates extremely low, and that it encourages investors to take on other types of assets, kind of diversify their portfolio to look for yields. And that QE push is not new. We've had it now for the last 10 years or so since quantitative easing or balance sheet expansion started, but it's been much more extreme this time around when you think about the Fed's balance sheet growth.
So there's a well-founded belief, in John, you mentioned this sort of as greater Boston goes, does the state go, and yet with that effect on downtown office space sort of most exacerbated in large urban hubs. And Michelle, this may be true around the country, right? When it comes to urban hubs, are there opportunities for sort of smaller gateway cities like Worcester to sort of fill a different need, obviously a much lower priced area? So
yeah, so certainly an opportunity. I don't see the hollowing out of a city like Boston as a price-based event. I see it more as a health, safety, comfort level-based event. And the other side of that coin is the fact that the work from home for those companies, that I'm thinking of in Boston that have been successful in that pivot, you now have the opportunity to avoid some costs for those big downtown Boston rents. Does that mean a relocation from Boston to Central Mass? I don't know. I don't think so. I think initially it's more a shrinking in place, which then makes more inventory available in a city like Boston. And I think at some point that begins to have an effect on price. The ultimate sort of gatekeeping factor for this is how quickly do people feel comfortable coming back in large pre-pandemic numbers. I think of my own staff. So I have a staff of about 50 people. As I said, we're on the 16th floor of One Beacon. The vast majority of my employees come to the office by public transportation. So to the extent that people aren't comfortable getting back on the MBTA, that suppresses turnout. And so I know that's kind of a long walk around the block with not a really precise answer, but I think, again, if this were a price-based migration, I would say, oh, great opportunity for Worcester, but it's more a public health and employee confidence issue.
Got it. Michelle, what are you seeing in terms of, major urban centers recovery? And maybe Travis will have a real estate perspective as well on that.
Yeah, I mean, I generally agree with John, is that there was this kind of significant shift as a result of the pandemic as people left the highly dense areas, both in terms of from a job perspective, but also residential. And in theory, once the virus is contained, once people feel comfortable going back into dense areas and into cities, that will happen to some extent. That said, I do think that there's been some shift from at least the survey data we look at, from companies thinking about having these large centralized locations where everybody's in one building in a big urban area, versus having a lot of these kind of smaller hubs, many different areas where it's an easier commute. People have the ability to be with one another virtually, but you can have these kind of centralized areas where people can be together and work efficiently while also having flexibility of working more virtually. So I think that there probably will be somewhat of that. I mean, especially as these companies think about the relative costs, from a big urban area versus some of these smaller suburban cities. At some point, if the costs normalize, right, and if a city like Boston becomes cheap enough, then people will flow back in. I mean, there's a lot of advantages of being in big urban areas. That's why urban areas have done so well. You have a lot of efficiencies from that. But I think in the immediate term, as companies think about the near-term future and how people have been working and how they might want to continue to work, I do think there is some appeal of having these smaller hubs. I mean, even for Bank of America, for example, we have obviously One Bryant Park in New York City is our big office space. But there's what was for a while kind of a backup disaster recovery site in Stamford, which is now a fully operating office. So I think there is some of that.
I think Peter had queued you up right before I jumped on, so you want to jump in from the real estate side of things?
Yeah, so I'll speak just in terms of the life sciences and not some of the other asset classes, but the life sciences, real estate tends to be a little stickier for people. People need to have access to this very high-powered, very specific equipment and facilities that are located within the office lab context. So there's a degree to which, in order to engage in life sciences R&D and the entire life sciences business model, you have to have access to physical infrastructure. So that's not going away anytime soon. What COVID accelerated, and this is what I think we're watching, and not just applicable to Massachusetts, but across the United States. What COVID accelerated was the utilization and deployment of artificial intelligence, machine learning, and data tools as supplemental for the R&D process. Basically, taking your laptop and transforming your laptop into a lab. And in that regard, you have perhaps not fungible choices being made. I'm either going to be in the office or either going to be at home, but there's this new evolution of thinking about, what does work actually mean? When do I go to the lab? How do I gain access to my lab? How do I reserve lab for my experiments? When do I go to the office? How do I collaborate within my office? And then importantly, around living and where you call home, scientists still want to be around one another. They need to be able to collaborate with one another seamlessly. So, and that drives home purchasing and residential decision making as well. If you live in Lexington, for example, are you going to be around your peer group? More so than if you live in Leominster. It's not about which community is better, but it's more about your ability to be able to cluster around your scientific peer group. Now, there are ways communities can put their thumb on the scale in order to facilitate that kind of decision making. You know, investing in K-12 education is one great way, and investing in scientific pedagogy within K-12 education is a great way to put your thumb on the scale. But at the end of the day, it's about those two concepts. You know, the stickiness of real estate, and at the same time, the need for interpersonal collaboration within the sciences.
Brad, I see restaurants, I think, can be part of the resurgence out of the greater Worcester area. First of all, as everybody knows that lives there, it's been a dynamic, growing restaurant community with really great operators for a while now. I mean, it's second to the Seaport area. It led the state and probably most of the Northeast in terms of explosion of restaurant growth. But the advantage it has over Boston, you know, when you look where you draw from, it's a relatively short circle for how far people will go, and the ease in and out of Worcester is pretty significant. And Boston has nobody to grab from the east. I mean, you can't get to Boston from the east. You're coming on a transatlantic flight from over across the pond, whereas Worcester grabs out of all of Metro West. And so I think restaurants will bring people back into the streets of Worcester, and will start to breathe some life into there, and that will help as we look to recover.
Well, great. Thank you, Bob, and I appreciate all, including the audience, having patience for my own technical difficulties. I'm going to jump into a question, sort of modification from our first Q&A from the audience here, from Gina DeCruz from Neighbor to Neighbor, which has to do with increasing diversity in the workforce. So since George Floyd's death in May of last year, there has been a more vocal and visible effort to increase diversity in leadership, including efforts to provide more opportunity for underrepresented groups. Sort of a two-part question for all of you, and Bob, I'm going to put you on the spot first because you just finished. How are your own industries and organizations sustaining this commitment, and how do you think, if that commitment is sustained across the economy, how will the increased opportunity for the entire workforce impact the region's long-term economic vitality?
Yeah, so look, I mean, one of the things that I'm proudest of that I've stayed in this business for, and I touched on this earlier, for so many years, is the fact that in the restaurant industry, you can literally come in. You need to know how to treat people right. You need to know how to take care of people, and if you do that, you can succeed. And success in the restaurant industry often means moving from line positions, getting trained. We're probably a leader in English as a second language in terms of many of the restaurants and restaurant groups, taking people right from that standpoint and giving them growth in terms of skills and development, but allowing them to grow into management, middle management, and ultimately, and this is where we really are well represented, minorities, women, there is no higher industry, if you would, where entrepreneurship is represented very well across all those lines. And so I've always felt like we're the land of hope and opportunity for folks that really want to get ahead. One of the challenges is, and I also talked about this, is the barriers to entry into this industry, to entrepreneurship, is relatively low. And one of the challenges is people get into it and they're not really well funded. And to get through something like we're in now is really a challenge. But it's a challenge every day. And so we've got to do a better job of sort of educating folks about the fact that you don't just have to get the four walls, the front door is open. You have to be able to sustain it for a little bit and make sure that you're successful in doing so. So I think we've had opportunities for many, many years. I think we will, again, be a leader as we come through this resurgence again.
John, I'll throw that same question to you. Impact of an increased diverse workforce on long-term vitality in the region.
So I want to speak about this in two different areas. One is with respect to AIM as a trade association and as an employer, and then relative to our 3,400 member companies all across the Commonwealth. So the first thing is, for the last couple of years, AIM has been focused on diversity and inclusion as an integral part of who we are as a trade association. We've built a framework to try to encompass diversity and inclusion in everything that we do, from who we're hiring on our staff, who's on our board of directors, and what are the public policies that we advocate for, and how are they affected by the lens of diversity and inclusion, and how do those concerns around what I stated earlier around this notion of Commonwealth, how does that inform the positions that we take up at the State House? So that's one basket. And we're still, as I said, a couple of years in. There's a lot to do. We have a very full agenda for 2021 to try to accomplish and to further our journey in terms of diversity and inclusion. With respect to the members, so we have, within the membership, we have some very well-known, very successful companies who do an outstanding job on diversity. And I'm not name dropping here, Michelle, but last night I had the opportunity to hear from somebody that you probably know, Brian Moynihan, who sits at the very top of the Bank of America food chain. And he spoke for almost an hour about the commitment of the bank to diversity and inclusion and the accomplishments that have been achieved over the last 15 years with Herculean effort, but persistent and consistent effort. And so what I'm hoping to do as 21 goes on is to take companies like Bank of America who are members, have them sort of help our other members figure out why this is important, how to go about doing it, how to create the programs that work, and then how do you measure success going forward. So it's one of those things where, as we all continue to focus on this, the impact across the Commonwealth will be significant. The last thing I want to say is one of the pillars of our effort is to try to get our own members to engage in an effort around supplier diversity, so that as our members are purchasing goods and services, they're thinking about purchasing those goods and services from businesses owned by Black, Latino, women-led companies, so that that economic activity and that economic opportunity penetrates all across the Commonwealth.
Travis, Michelle, same question. I don't know who wants to pick it up next.
Yeah, I'll put a different spin on it for the life sciences and make it like real personal. Which one of us would like to go to the home of a patient suffering from a rare disease or a rare condition and tell that individual that one of the reasons why they don't have a cure today is because there are tens of thousands of jobs that are open and available in this industry that are not being filled because we refuse to hire a diverse workforce? Which one of us would like to go have that conversation, right? And that's the problem and the challenge that our industry is facing, whether you're talking about post George Floyd's murder or not. This is the core issue that our industry is facing. And some of us have been taking up this challenge, frankly, more so than others. So I'm really proud to be from Massachusetts on this. Lieutenant Governor Polito has been a champion of women entrepreneurs and investing in women entrepreneurs in the life sciences for years now. Governor Baker has been a champion of workforce development, workforce training, and internship programs for diverse cohorts for years now. We have organizations like New England Venture Capital Association and others that are trying to organize capital around investing in scientists and leadership in the life sciences. But make no mistake, this industry is built on one fundamental competition, and it's not for real estate, it's for talent. There is a major metropolitan area out there that I had a conversation with last week that is making part of their strategy, a direct part of their strategy, going after the thousands of Black and Latino scientists that graduate from our colleges and universities in Massachusetts, and offering them the opportunity to come to an environment where they feel like their talents will be more respected. That is a direct challenge to us and our ecosystem. So this is not just for us in the life sciences. This is not just the province and the responsibility of the individual company itself. This is the province and the responsibility of us all who are trying to make communities friendlier, safer, more open, without glass or steel ceilings for everyone, regardless of background, race, culture, creed, sexual orientation, you name it, to be able to achieve their ambition. So we could all go to that patient and tell her, yeah, we've got the best on the field working for it. Everyone's off the sidelines and in the pool. That's the challenge. And I think there are some of us who are taking this up, and some communities that are taking this up more passionately, unfortunately, than others.
I could just, I guess, quickly jump in from a broader economic perspective. But first, Travis, hats off to you. That was a great and passionate view and perspective, and one that I think we can all really learn from. So before I get into the economics, just to speak to what John said around Bank of America, I do feel very fortunate to be working for a company that has a leader like Brian Moynihan, where it is absolutely essential to how he conducts business on a daily basis to ensure that there are these diversity initiatives that are being met. And you can see it from every level of the bank, whether it's small business lending, where there's a particular focus on getting access to funding for minority-owned businesses, particularly female minority-owned businesses, that there's a direct and targeted approach to also, of course, philanthropy efforts and creating a broader network in the banking community to make sure that there is access to financing, there's access to capital, because that is obviously extraordinarily important. As Bob noted, a lot of the restaurants, if they're starting out, but they don't have the financial wherewithal, it's going to be harder for them to make ends meet and harder to succeed. So we need access to funding, we need access to finance, we need the markets to be open. And there has to be an intentional effort to make that work. From a broader macro perspective, I mean, clearly when there's greater equality, there's greater prosperity in the economy. And you think about the focus on income inequality in particular in the economics community, there's a ton of research out there that when there's greater inequality, there's just less spending, because more and more of the wealth, more and more of the dollars are in the hands of people who have a low propensity to spend and a higher propensity to save. So if more of the income is indeed distributed widely to the lower income population, they're more budget constrained, more of that money will go out into the economy, and that multiplies and has a lot of favorable ramifications for the economy. Similarly, when you think about the labor force, to have a broad labor force, to have opportunities for people on the fringe of the workforce right now. The more people who can be working, the more productivity we see, the more wealth creation we have, and the better we'll be for potential growth. And I think all of these economic arguments are front and center right now for the Biden administration. If you think about the economic team in the Biden administration, the topics that come up more than anything else is getting an equitable recovery, addressing the inequalities, and creating that inclusiveness when it comes to recovery. as well as climate change. Those are the two things that are absolutely driving the economic agenda right now. So I think we're going to see hopefully some real changes in the next few years.
Well, great. Michelle, I'd hate to cut us off early, but unfortunately we were butting up against the time. So Travis, John, Bob, and Michelle, those are all wonderful presentations. Before we got to the Q&A, very thought-provoking Q&A. I wish we could go on forever, but we are at 1 o'clock, so I'm going to hand it back off to Peter Seton to round us out.
So thanks, Brad, and thanks, everybody. I just want to thank once again our partners, the Regional Chamber of Commerce, Worcester Regional Chamber of Commerce, our presenting sponsor, Bank of America, corporate sponsor, Bolus Lynch, and supporting sponsor, National Grid. I mentioned earlier the contest where we showed who people thought the Democratic nominee would be for president. And I want to go through now the slides of who the winners were from last year and encourage everybody to send in the survey. We're going to send a link to a survey for 2021, and all of you can be recognized on this big stage next year when we have this event for guessing these things correctly. So the first slide of the Economic Awards contest is guessing where the Dow Industrial Average would land on December 31st. In first place, we have Tom Hastings of West Plain Capital. He guessed very close to the 30,409 that the market ended up at. Tom Collins and Kerry Salwa were second and third. The first place winner gets a $25 gift coffee card. Second slide, annual GDP growth. As Michelle mentioned in her presentation, GDP growth was actually negative 3.5%. So the most pessimistic projection last year was John Bobin from Cambridge Savings Bank of a 1% growth. And therefore that was the closest to negative 3.5. And John Pica, Blaine Marchand, and then I had a 1.8. So that's your top three there. Next slide is federal unemployment rate. The real answer was 6.7%. Again, John Bobin of Cambridge Savings Bank was the least pessimistic, the most pessimistic last year at 4.75%. James Cushman and John Pica again in third place at 4.1. And then the next slide is the Massachusetts unemployment rate. It was actually 7.4% at the end of the year. And you can see John Pica again. We're seeing his name a lot. James Cushman from Bartholomew and Company, 3.9. And Hamid Mohagan at 3.6%. And now the big slide, the overall winners. So this is the combined best score. This is like golf, the low number wins. The combined best score, and the overall winner was someone who must be spending some good time getting insights from Michelle, because he knew where things would land. That's John Pica from Bank of America, first place. John Irwin of UMass Medical School, second place. James Cushman from Bartholomew and Company, third. Richard Zupan of PDC Identicard, fourth. Tied for third, rather, at 46 points. And all three of them will be receiving a restaurant gift certificate in the mail. So again, we'll send a link to the survey for this year out to everyone, so you can get your predictions in. Thank you again to all of our speakers and everybody who was part of this event. Again, you'll get a recorded link that you can share with friends. Have a great afternoon, and thank you again for joining us.